Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk to you about the tax planning ideas that we often talk to our clients about in order to help them minimise their taxation liabilities this financial year. And obviously, leading up to 30 June, it's pretty good timing to have this conversation. Now, of course, any information that I provide in this podcast is naturally general in nature. I don't know your circumstances and everyone's situation is different. So please, before acting on any information in this podcast, please check with a appropriately licensed and experienced professional before you go away and implement any ideas. In any case, I'm just going to roll through a few different situations and ideas and tactics that you could consider implementing before 30 June in order to reduce your taxes. So the first one is work from home tax deductions. I did a podcast on this when the coronavirus hit, which you can obviously listen to. Since doing that podcast, in fact, ironically, a week after releasing that podcast, the ATO came out with a shortcut method to calculate such deductions. And essentially, anyone working from home between 1 March and 30 June 2020 is able to claim a deduction equal to 80 cents per hour they've worked from home during that period. If you have more than one person in the same household working from home, so husband and wife, for example, each person can claim the 80 cents each per person and put that into their tax return. If you use this shortcut method, you can't make any other claims, so internet or phone usage, these sorts of things. It's a sort of catch-all tax deduction, if you like. If you don't want to use the shortcut method, there's a couple of other methods in which you can calculate, home office expenses, which I covered in much larger detail in that previous podcast. And there's a link to that blog in the show notes and also on the website. So let's talk about personal super contributions, because that's really a very, very common way in order to reduce your taxes. So let me run through a few of the rules at a high level first, and then I will turn my attention to whether you should actually be making such contributions. So really, anyone that's that's younger than 65 is able to make a personal superannuation contribution up to $25,000 a year into their superannuation fund and claim a personal tax deduction for that expense. This $25,000 cap is called the concessional contribution cap and includes any contributions that an employer makes on your behalf. And so that includes the mandated or mandatory 9.5% contributions if you're a PAYG employee. That's counted towards that $25,000 cap. These contributions are called Superannuation Guarantee Charge. If you earn $250,000 or less, those contributions received by the super fund will be taxed at a flat rate of 15%. So therefore, by putting additional monies in super, instead of being taxed at, say, 47% if you're on the highest marginal tax rate, you're taxed at 15%, so you're saving 35%. In terms of tax amount on the amount that you're contributing to super. So it's a good tax saving measure, but also it's a wise thing to do to boost your superannuation savings. However, if your income is more than $250,000, then the contributions are taxed at 30%. So you'll still get a saving. That saving in that situation is 17%. So it's still not as good as 35%, but still a saving, albeit at a lesser amount. Generally speaking, if you expect your taxable income this year to be materially higher than $90,000 and you have sufficient savings, so you have a large enough cash flow buffer, to fund 6 to 12 months of living expenses. You don't have significant debt exposure. Then arguably you're in a good position or would benefit from making additional super contributions and potentially taking your contributions up to $25,000. If you earn less than $90,000, then as a tax saving measure, I'm not suggesting it's not a good idea, but as a way of saving tax, probably not going to save you very much tax at all, and questionable whether you want to actually do that. So that's super contributions. So let's talk about some scenarios then, and what you can potentially do. Firstly, what could you do with super contributions if you expect your income this year to be higher than next year? But also, what can you do with super contributions if you expect next year's income to be higher than this year? Okay, so if your income is higher this year compared to next year, either because maybe you've received a bonus this year, or you've crystallised a capital gain, or in fact you've changed roles and your income will be lower next year, then potentially one of the things that you could take advantage of is the carried forward rule. So essentially the laws changed a few years ago, which allowed you to use unutilised caps, superannuation contribution caps, from prior years. Now, this rule commenced on 1 July 2018, so the beginning of the previous financial year. That means that if you didn't contribute your full $25,000 cap last financial year, so that's the financial year ending 30 June 2019, then you can utilise some of that cap or all of that cap in this year. So let me give you a quick example. Let's say in 2018-19, so last financial year, you contributed $10,000 in super. So you had $15,000 of unutilised cap. And this year you haven't contributed anything yet. By using the carry forward rule, you could potentially contribute the $25,000 that you're entitled to use this year, plus also the $15,000 that you didn't use last year equals $40,000 in total contributions. And you can claim a tax deduction for that $40,000 in this financial year. Now, you can only do this if your super balance was $500,000 or less as at the beginning of this financial year, so 1 July 2019. The carried forward rules, as I said, are new. It's kind of the first year in which you can use them, and it's a good way of shifting tax deductions into different financial years if you're able to do so. If you have a self-managed super fund, then potentially you can actually contribute next year's contributions as well. But you've got to be very careful about this. This strategy is called contribution reserving, and you need to speak to your advisor and tax accountant to make sure that you're able to do this. But potentially if your taxable income is unusually high this year, then potentially bringing as many super contributions into this year as possible is a good way to reduce your taxes. Another strategy is to potentially pay for interest in advance. Now, this is only applicable if you have investment loans. So, if you've borrowed to invest in the share market or the property market. And essentially what it means is that you prepay 12 months worth of interest in June. And so essentially you're paying next year's interest in June, and you claim a tax deduction for that this year. Given interest rates at all-time lows, particularly fixed rates, whether that's going to be advantageous and how much tax that's going to save you is something that you'd have to look at in your scenario. Certainly when interest rates were much higher, it would save a considerable amount of tax and be well worthwhile. Maybe that's more marginal now, given where interest rates are. Okay, the second scenario is where you expect next year's income to be significantly higher than this year's. Again, maybe you've got a pay rise, maybe you missed out on a bonus this year, or maybe you do expect to crystallise a capital gain next year. So if that's the case, what you could potentially do is, using those carry forward rules, is not make any additional contributions this year and save them up so that you can utilise them next year. So you carry them forward and use them in the 21 financial year. And again, sort of shifting tax deductions. So these carry forward rules really do give us a bit of latitude to plan in regards to tax saving measures. Leading on from super contributions, there are some other strategies in which you can utilise to reduce your taxes, but also potentially boost your spouse's super. There's two options here: government co-contributions and spousal contributions. So let me talk about them individually. Government co-contributions means that if your income is less than $38,500 and you contribute $1,000 into super as a non-concessional after-tax contribution, the government will also top that up and contribute $500. So it's not going to change your life, but it's a free $500 if you put $1,000 into super and your income is under $38,500. So that's government co-contributions. The second one is spousal contributions. So if your spouse earns less than $37,000 and you contribute $3,000 into their super, you will be entitled to a tax offset of $540. So that's an offset rather than a tax deduction, which means that it will save you $540 worth of tax. So again, it's kind of a free $540, and it might boost your spouse's super as well. Some other ideas, or at least one other idea, is that if you've crystallised capital gains this year, it might be wise to think about if there's any dud investment assets that are currently in a capital loss position that you might want to sell before 30 June to minimise your capital gain. Capital gains are normally added to your taxable income in the year the CGT event occurred, and capital losses can only be offset by capital gains. And if you don't have any capital gains in that year, you can carry forward, or you may be able to carry forward those losses. So in years that you do incur a capital gain, always good to see if there's a loss available to soak some of that up. Apart from that, there's not really a lot of other tax saving measures available at this particular stage. Quite often you need to spend money in order to save tax, but just chasing a tax deduction and spending money willy-nilly doesn't make a lot of sense. Really, it's important to make sure you're spending on things that are ultimately going to build your wealth and help you achieve your lifestyle goals. And that's why super contributions are a really good thing, because it does help you save tax. But if your super is invested wisely, maybe I should underline that if, then it can be a really good thing from a long-term wealth accumulation perspective. Look, if you're confident that you are taking advantage of all opportunities to reduce your tax and you're still unhappy, then maybe the best thing to do is spend most of your energy on making sure your pre- and post-tax dollars are invested as efficiently as possible, rather than wasting too much energy trying to think up tax deductions or chase the last sort of $10. Maybe your time and effort and attention are better spent really building wealth and making more money rather than trying to save tax. Because the reality is, within the black letter of the law, there's really not a lot of scope outside of the things that I've just spoken about in order to help you do that. And perhaps if your financial position is advancing at a greater rate than it currently is, maybe you'll feel less anxious about paying so much tax each year. I don't know, just a thought. Anyway, that's it for me this week. Until next week, bye for now.